Hello and welcome to Public Forum. The German Parliament has voted in favour of starting negotiations on Greece's €86 billion bailout deal. Germany was the last of the Eurozone countries needing parliamentary approval to begin the talks, with Greece voting to accept hard-hitting austerity measures earlier this week. This paves the way for the reopening of some Greek banks on Monday, following weeks of closures after the European Central Bank raised the level of emergency funding available. Separately, the European Council approved a €7 billion bridging loan for Greece from an EU-wide emergency fund. It means Greece will now be able to repay debts to two of its creditors, the ECB and the IMF, due on Monday. The bailout deal is being seen as the last attempt to resolve the Greek crisis. Remember, Greece has debts of €320 billion and is seeking its third international bailout deal. Last month, it became the first developed country to fail to make a repayment on a loan from the IMF. Today in Public Forum, we discuss how did Greece get to this point, what all does the new deal entail, has the possibility of a Greece exit from the Eurozone been avoided, and the road ahead for that country. And to discuss the Greek crisis, we are joined in the studios by an eminent panel. Please welcome Professor Gulshan Sachdeva. He's the chairperson at the Center for European Studies, JNU. Welcome to the program, Professor Sachdeva. We are also joined by Pramit Pal Chaudhary, Consulting Editor, Foreign Affairs, Hindustan Times. Welcome to the program, Mr. Pal Chaudhary. We are also joined by Mukul Sanwal. He is a former UN diplomat. Welcome to the program, Mr. Sanwal. Professor Sachdeva, I'd like to begin with you. It's been a week of fast-moving developments for Greece. After marathon talks, a third bailout deal was announced, following which the Greek Parliament adopted some strict and urgent reform measures relating to pensions and VAT and so on. And now, of course, the German Parliament has also approved talks on the new deal. But what all does this new plan entail?
Well, you see, the crisis in Greece is not new. This has been there for the last 5 years. Only thing which is new actually in this whole drama, which has been going on for now so many years, that many of the European institutions, particularly ECB and Commission, and German government particularly, till few days back, it seemed they had made up its mind, or made up their mind, that if there is a possibility of Grexit, possibility of breaking of Eurozone, so they had kind of prepared themselves for that kind of eventuality. Now, it's not a simple thing to kick any country out of Eurozone, because technically you can't do it, because there is a possibility you can be out of EU. There is an exit clause under Lisbon Treaty, but within Eurozone, actually there is no exit clause unless that country itself wants to get out of that Eurozone. So it's not that simple issue that you can just tell Greek to go out. Only thing is that they created conditions like that. Ultimately, the kind of government you have in Greece, it will be very difficult for them to swallow that kind of deal. But ultimately, at this point of time, despite all the problems within their own party, within Syriza, within the Greek political system, and the humiliation which the government and the country has gone through in the last few days and weeks, perhaps they have realized that still it's better to be in Eurozone rather than be out of Eurozone. Okay. You see how this whole thing has started. Now, when cutting the long story short of last 15 years, any country which wanted to join Eurozone, they had to fulfill a convergence criteria. And it has many conditions, but two major conditions of that convergence criteria was that your fiscal deficit has to be less than 3%, and debt GDP ratio has to be not more than 60%. Now, obviously, they have flouted this. and now the Greek debt is almost 170-80%
Right.
of the GDP, and fiscal deficit from the 2009-10 itself,
Right.
it was revealed that it was much more than 3%. But this is also a fact for the first 10 years. The Greek economy really took advantage of the conditions which were created because initially it was a risk country, so
Right.
the interest rates were pretty high. But once they joined Eurozone, after fulfilling this convergence criteria, along with that you also have a low interest rate and low inflation and independence of your central bank and other things. So the credibility increased. When credibility increased, all financial institutions from the northern countries, they lent to the Greek government as well as to Greek consumers and firms, lot of money at a very low interest rate. So as a result, a lot of money flowed into these countries, not just Greece but also other peripheral countries like Ireland and Spain and others. So a lot of money came and the economy was booming. In fact, if you can look at the figures between 2001 and 2007-8, these were the countries which were actually outperforming all other countries within the Eurozone. But once you had a crisis in the US, suddenly all those financial institutions became very cautious.
Right.
And when the figures also came to be known that the fiscal deficit and other figures which were shown actually were not really correct.
Right.
So suddenly the confidence which was built within the system, that confidence eroded, and money dried up. When the money dried up, so obviously there was no more money now to repay earlier debt which was taken. So in a normal circumstances, it's not that it was the first country which was going to default on a sovereign debt. This happened in so many countries in Africa, in Asia, in Latin America. But in this case, now since this was a part of a single monetary policy in which so many other countries are involved, and within that economy it was a relatively smaller country. Because in normal circumstances, you go to IMF, you devaluate your currency, and then they will put certain conditions, and then within few weeks or few months or few years, your economy will come back to kind of normalcy, and then you can go on. But here, you cannot devaluate your currency,
Right.
Because you are part of a single currency. But at the same time, earlier there was not even any possibility of providing bailouts, because that they never thought initially within the European institutions. But somehow they roped in even the IMF to put certain conditions
Right.
on Greece. So what you have a situation now, and this has been going on for some years, but what now has happened is, because you had earlier also two bailouts of more than
Right.
200 billion euros, but at that point of time it was not just Greece, but other economies are also very much affected. But now I think in the last 2 or 3 years, what the Europeans, it seems to have done, somehow, for a couple of years ago, say in 2013-14, it was looking more of a Eurozone crisis.
Okay.
So the Eurozone crisis, I think now they have been able to convert it into a Greek crisis.
Right.
And somehow they have created a certain firewall within the system, through European stability mechanisms and others, that if that situation arises when Greek has to go out from the Eurozone, they have enough capacity, enough system within that place, and even the banking union and other all kind of conditions which they have created for the last
Right.
2-3 years.
Right,
So within that
Professor.
thing, they have been able to convert it into a Greek crisis,
Okay.
and they are even prepared anytime that if situation arise and Greece is out of Eurozone, they should be able to,
We'll discuss
get
the
this
possibility
pressure,
of Brexit in
Yeah.
greater detail, and we'll also discuss whether or not Greece has any contingency plans in place. But Mr. Pal Chaudhary, we understand this conditional agreement that Greece has won. Under it, it is set to receive around 86 billion euros for over 3 years, but it has had to make substantial concessions in return, severe austerity measures. What will be the impact of these measures, and are these reforms going to work?
Well, it depends on how you define as what works. The impact is going to be very clear. Greece has already been more or less in economic recession for the past 5 years. It has unemployment levels of about 25% or more. That will obviously continue because the government in particular has had to massively restrict expenditure to reduce its fiscal deficit. And since Greece doesn't have very much of an economy other than the government, tourism, and some agriculture, the debt consequence for Greece has been quite devastating. When Tsipras, the present government, had come to power in January, Greece had been heading for some mild recovery of about 2.5% growth, which was actually quite good. Partly because of the consequences of his own battles with the Eurozone, that now growth is probably going to be about 0.5%, which effectively means no growth at all. So he will now Greece will have a combination of zero growth, high austerity, and almost certainly greater unemployment than as it's been having for the past couple of years. So we will expect the austerity to continue the recession for quite some time. Greece is hoping, and here they have the backing of the IMF, that some of their debt will be reduced, will just be written off or somehow lessened in structure. And I think Germany has proposed or said perhaps we can at least extend the payment period and reduce the interest rates to make the cost less. But for Greece, yes, they have the economic future is quite bleak, and Greece's only safety valve right now is that Greeks are leaving Greece. They're all moving to other parts of Europe to look for work.
Right. Mr. Sanwal, there are many areas of economic reforms that are part of this new bailout deal that will be negotiated in the coming days. This includes, taxation, pension, labor reforms, banks, privatization, and so on. But privatization, we understand, has been a major sticking point in this agreement. What can we expect in this regard, and what kind of implications do you see, of this, on the question of Greek assets being monetized?
No, before I come to that, I just want to add a couple of points on the discussion earlier. One is that Greece has just 2% of the world economy, but yet why is it that Greece has created such a stir in Europe and in the world? The thing is that the impact of the 2008 crisis was very severe in Europe and particularly severe on Greek, and they fudged the figures of their deficit. They got Goldman Sachs to help them to conceal the figures, but at the end of the day, as the market changed, their deficit doubled. So that's just one example of the mistakes that they had made quite consciously. Then the private sector debts were taken over by the European banks, so they eventually became government debts. Now most of these debts are from Germany and France, and so they have an interest to make sure that there is no default. Now the third interesting issue here is that they do not have to repay interest till 2020, and they start repaying capital in 2023. So why is the problem? The problem is that the bailout that they are being given, or the loan that they are now being given, over 90% of it will be taken back. It will not come to Greece at all.
Right.
Now, there are some reports which I have read which say that in this entire transaction, in the first and second bailout, the Greece got hardly 23 billion, not the 360 that is being talked about, because that is all being recycled back. Now, what is new now? The new is that austerity measures were there. There is the IMF, there is Stiglitz and other economists who are saying that, hey, this is not going to work. You have to jumpstart, you have to improve the economy rather than curtail it by this reason. But what is even more interesting in this bailout is that Angela Merkel insisted that 50 billion of Greek assets will be pledged to Europe. So they have really taken over 50 billion of Greek assets now, and they are going to sell them as a repayment. Now that is being criticized as an attack on the sovereignty of a country. So what we have is that what started off as meeting European criteria of financial stability, a country fudging that, taking loans because the banks in France and Germany found that this was more lucrative than keeping them in other locations or other avenues, and then not able to pay back because their own profligacy. You see, their retirement age is 50. They spent a huge amount of money on the Olympics. So there was no chance of repayment. But the important point is that just been made that their economy was recovering. it was the repayment schedule that was more important. The fact that they had taken so much debt, 200%, almost 200% of GDP, 25% contraction in the economy, some people saying that 50% unemployment rate, not 25 but even up to 50%. So they have a huge problem on their hands. Now the IMF has come out very clearly that they will be part of the New Deal, which the Europeans have been pushing for the IMF involvement because they want the IMF to monitor the Greek economy, not the European Union, an outside force because of the bad blood that has taken place. And the IMF have now said that hey, we will only get involved if there is serious debt restructuring. They are saying, look, in the present conditions, these people cannot repay. There are economists, the United States has come in too, saying that look, it is not possible for them to repay the kind of terms that you are imposed on them. You will take over their assets, but you need to give them certain debt relief and restructuring, and that is being opposed by the people who have lent the money, that is France and Germany, that it will have a knock-on effect on Spain, Poland, Ireland and other countries. So really, I mean, the Greeks are to blame, certainly, because they put themselves in that situation. But the people are also questioning the entire European project as such in this condition.
Right, we will come back to that. We'll discuss it in.
Because that is a very important issue in
of
all
course,
of this.
I'll come to it. But Professor Sachdeva, you know, many believe that Greece's debt burden, it can never be repaid, and these painful conditions that are being imposed on people, they're not working. What do you think?
Well, you know, this is, I mean, you know, this particularly Greece crisis has also raised some very fundamental questions. I think one question which is raised of the European project, which perhaps we can discuss if there's a time. Now, the second question is also about the way IMF policies have been, or in fact not just IMF policies, but the policies of austerity, which have been kind of imposed on Greece.
Right.
I mean, this is not something, this is something very new which IMF or other financial institutions have done. They have done it, you know, in n number of countries in the last 20-30 years. In many cases, they have not worked, but still they were continuing with similar kind of policies. But suddenly now, even IMF itself, in some of the, even the senior economists within the IMF, they themselves are even raising doubts about those policies. Now, it's very interesting development why they did not raise these issues when this issue was, these kind of austerity measures were being imposed on so many developing countries. Now, suddenly you have one European country which is a part of a kind of a developed you know, group of the countries within Europe, a Western country, you know, European country, and where your policies are not working, and suddenly now you know, these things have been questioned, and those policies were being questioned actually by so many economists in the past also in so many developing countries, but it was never really became a major issue within the IMF. You know, they always thought that this is the way, because as a banker, if you are providing money and if the countries, and these are the only kind of right policies which we are you know, we are recommending to those countries. So now in a sense something good may come out from this Greece crisis, which might be useful in the larger debate of the kind of policies which IMF have been following, and in many cases there are clear examples that it has not really worked. It has made situation worse in many economies, and the similar thing has also happened in Greece, because in the last 5 years what actually this government was saying when they were negotiating you know, in the last couple of weeks, just before this you know, the main point which came now, they have to surrender basically their negotiating positions. What they were saying that the policies for the last 5 years has not been working. Our economy has already shrunk 25%.
Right.
So what we are basically saying, you just give us some more money, some breathing space, and let we have our own policies. We do not have the, you know, the tight monetary and fiscal policies what have been recommended by ECB as well as by IMF. So maybe those are the kind of policies perhaps which will work, because we do need growth. And if there is no growth, so obviously how our capacity to repay would shrink further, and this is exactly has happened. But now what one has seen, that even if actually he went, I mean the Prime Minister went for a referendum, and people said obviously no, because if you ask from, you know, general population whether you want austerity measures, obviously people would say no. So they obviously said no. But after that, even when people said no, and then he has to basically accept all those conditions which
Right.
which people have already rejected. So there are serious issues, and Greek economy is in a serious situation from which it will be very difficult for them to come out, unless of course there is certain debt restructuring. Now again, what many ministers within Germany are saying, now the Eurozone is a group of relatively developed countries, or in fact developed countries with the high competitiveness of those economies. Now you can't have debt restructuring and then your membership of the Eurozone. This is what many Germans are basically suggesting. And if your situation is like this, that you are not able to even repay your debt, and you don't have the capacity to repay, so please be out of Eurozone, and then go ahead with your own kind of proposals.
Okay, Mr. Sanwal.
You see, the interesting thing is also that a large number of very different kind of questions are being raised. People are now saying that, look, the European project really benefited Germany. Their exchange rate was quite high. Coming into the euro, they were able to lower that and capture the export market. And the entire euro project has really given a bad deal to the southern countries.
Okay.
And the northern countries have benefited, relatively speaking, more. The other thing is that the IMF debt restructuring is also raising the issue that the origin of this is not debt given by the IMF or the European banks. It is private banks who lend to these people.
Right.
And then the IMF and the European banks took over that debt. So the entire mechanism of how this came about is also getting questioned. These questions were not being raised when Thailand or the other countries were facing similar problems. But now these countries, Greece is facing this problem. These issues are coming up, and I think that is a positive step.
Okay. On that note, we'll take a short break in the program. Stay with us. We'll be right back. We'll continue the discussion on the Greek crisis.